Hey everyone, Eric here. Up next is the long awaited part two to my call diagonal slash leap call diagonal strategy. Part one was essentially an overview of the trade, kind of the general rules and whatnot. Part two, this video, I want to get into a little bit more depth on structuring the trade as well as an overview of how we manage in different scenarios. And then part three, I'm going to do a practical application. And this way, I think that we can tie that strategy all the way through. That's really still the plan for my covered strangle strategy as well. I just haven't had any examples move kind of past the short call assignment and then additional management phase. So, this is going to be a little bit of a heavier video, so I'm going to do my best to be as clear and articulate as I can. But if there are specific questions, let me know. The other thing that I absolutely recommend is make sure you check out the Love LUV diagonal that I had on, as well as ABBV. I just sent out a couple examples of a trade in the works on those a while ago. So those can, help with some of the content we're going to go through here. So first off, trade structure. This one's pretty straightforward. The first one, like every single trade that I do, you got to allocate the maximum amount of money you want tied up in this trade. After you decide whatever that is based on portfolio fit, that's when we're going to start scanning for something that we like. For me, like I said in the last video, I like things that live in the S&P 500 that have weeklies, and generally I like it long term, aka I would want to hold stock. So this is just a surrogate way to hold stock. It's cheaper. So if that's leverage. So if you have, whatever that looks like for you to decide what kind of long stock you want to have, do that here. And then after that, you should end up with more or less a short list of things that meet your criteria for price and then things you would like to own. Then the next two steps are very important. The number three in chronological order is we need to look at the long call, whether it's going to be leap or just a long call. Depends on how far out in time we want to go, which will be one of the considerations we'll get to in a second. But the important part here is notice how I have initial. The reason why that's there is we have our maximum amount of money we want to put into this trade. When we're establishing the long call to initiate this trade, we do not want to assume that maximum allocation. I do this in every single one of my trades. If you haven't picked this up by now, I don't know how to make it any clearer, but this is one of the most powerful management techniques available to us is by keeping some cash on the side. As things go against us, we can scale into the trade based on our initial assumption and reduce our basis. So that is very important in this scenario, especially once we start talking about adjusted cost basis. So figure out what your initial outlay is going to be. Then decide what it looks like for you to scale into the position. So for me, I typically like to do, once I see a 5% move in the underlying, I assess. Another 5% move against me in the underlying, I assess, and so on and so forth. Then the short call. So this is kind of what's going to complete the diagonal. You need to figure out a couple key components to the short call. Now, in general, we're creating a balance. So when we have just long calls, it's going to behave just like long stock. It's going to go up as the underlying goes up into perpetuity. When we add that short call, what we're doing is we are capturing some profit, some known profit right now, and in trade, we are decreasing our future profit potential. So that's why I talk so much about selling at a ratio so that your upside isn't capped, and most importantly, managing your deltas so that you have no upside risk, which is, again, very common when we're looking at diagonals. So when you look at your short call, make sure you are going through that assessment of every time you add additional short calls, you are taking in money right now that you know is there, but the trade-off is if the underlying accommodates and goes in the direction you want it to in a big way, you are going to miss out on some of that move. So that's actually one of the beautiful parts of this trade is it gives you that ability to make that trade-off based on your market assessment. Okay, so for the long call, I went over this in my last video, but just a couple key points. Expiration 90 days to the maximum, whatever that is there. That's where I'm going to look. Strike price, it's got to be greater than 80 delta. Again, just once we get into some examples, you'll see why. And the overall initial outlay, the number of contracts, it's super simple. You just take whatever your initial outlay amount is and then divide it for the premium of the 80 delta plus call whatever one you pick. That's 90 days or greater out in time. And that's how you can very easily calculate what your initial outlay should look like. Next, for the short call, on the initial trade, I like to look at either one strike in the money or right at the money. The trade-off on your strike selection is the closer to the money you are, the more money you're going to collect up front, the less money you're going to make if the underlying moves and accommodates you. So the inverse is if you sell a short call that's a little further out of the money, you're going to collect less money up front, but will make more money if the underlying accommodates and moves in your favor. Just like a covered call, same exact trade-off here. So I tend to look something 2 weeks to a month and a half ish out in time. That's about the general time frame I look for these. My mentor, when he trades these, sometimes he'll use the short call that he sells for income. So he likes to do it within a month, but just kind of depends on what you're looking for. Now, it's so important to maintain that healthy delta ratio. So what I mean by that is when you're deciding how many short calls do you sell, you got to look at that delta ratio. So essentially, I like to maintain a 2.1 delta ratio, making sure that ensures that there is no upside risk. 2.1 delta, no upside risk, super important. So that's why I pick that figure. So what I do is I take the number of long calls times the long call delta, and you divide that by 2.1, that's our variable that we're defining, times your short deltas. And that will let you know how many you can sell without having upside risk. So that's why that delta ratio is so important. Okay, so moving over to trade management. Now, again, what I'm going to do in the next video is literally walk through an example. This is just to give us the framework and the understanding of what the example is going to look like so that people aren't lost. I know it's a little bit heavier than some of the other topics. So very simply, two basic scenarios can happen here. Either the underlying is going to go through and be greater than our strike, or the underlying is going to be lower than our strike. And let's take a look at what we do in these scenarios. When the underlying is greater than our strike price, typically I will just wait until we get close to expiration, minding early assignment. So if I am at any sort of risk of early assignment, I would make adjustments at that time. But essentially, when it comes time to put hands and manage on this trade, what I'm going to do is figure out how much it's going to cost to close the short calls, and I'm going to sell enough leaps to cover that cost. So this way, there's no money out of pocket added to this trade, and you are realizing profit in your leaps to cover the cost on the short calls that are in the money. So it's a really simple concept. Again, we'll work through it in the example, but this is how I like to trade these so that, again, I'm realizing profit on the leaps as well as not having to add any money to the trade, because in this scenario, your leaps or your long calls will have been appreciating in value. And again, if we were smart and set it up with that 2-to-1 delta ratio, the long call profit will overwhelm the short call loss. So that's why I like to sell the leaps to cover that cost and add no money to the trade. Next scenario is when the underlying is less than our strike. And in this scenario, it's pretty simple. We're just going to close that short call whenever we feel like it. I tend to wait until it's really cheap, maybe a nickel or a dime. And then that's when we can take a look at our long call and see if it's time to add to the position. And notice how I say examine. It's not just blindly scale in. Anytime that I have an initial outlay and then money set aside to scale into the position, before I scale in, I'm always going to analyze the trade and make sure that my initial assumption stands. The last thing you want to do is just start blindly adding money to these trades as the underlying is plummeting. Things have changed and it's no longer competitive, whatever the case is. And just because you have that as your management, you're adding shitty money to a shitty trade. It's not a good idea. Don't throw good money after bad money. But if you do look at the overall product, you see a pullback and you're like, yes, I still feel the same way about this product. I'm confident. Then that's when we want to, scale in. So that's why I have examined the long call there. So the last piece is once you make these sorts of adjustments, particularly when we are unwinding long calls, we need to keep an eye on our critical strike. So the critical strike is essentially how we decide where to sell future short calls against to ensure that we are not locking in a loss, because it's very easy to do that as diagonals go on longer and longer and you make adjustments. It can be very easy to sell a short call that's at the money, but if you actually take a look at a P&L profile or you do the math on it, you'll realize that, oh shit, at that short call, if we expire here, my position is at a loss. You do not want that. That's why this is very important. So, in order to figure out the critical strike, we're going to take our adjusted long call basis, we're going to subtract the current long call premium, and then we're going to divide that by the delta for the long call, and then we're going to add that to the current underlying price. Now, to figure out the adjusted long call basis, that's the formula above, where we're going to take the overall cost of our long calls. We're going to add any short calls that we've had to buy to close. And then we're also going to have the sold to close long calls come out of that. And we're going to divide that by the number of long calls we currently have times 100. So these two formulas are going to be really important in your longer term management of these positions. Now, I will say the platforms in general will calculate this essentially for you using that P&L chart on Thinkorswim, but I do think it's invaluable going through this process yourself and understanding how these formulas work. So what will end up happening again is when we go through the example, I'm going to, show how I'm going to calculate all of these as we're going through the trade. But, we're already at 14 minutes. Like I said, there's a lot that goes into this strategy to make it what it is and why it's a favorite. In the small stacks portfolio right now, the call diagonal strategy is just carrying the entire portfolio in a big way. This is a great strategy. So this is an overview of how we structure the trade and how we manage the trade. Next up, part 3, I'm going to work through an actual example that I'm looking at putting on sometime next week so that we can kind of follow that together. As always, if there's any questions or anything that you want to work through, let me know, and I'll catch everybody later.